The topic of today's conversation is how to trade the currency market in a low volatility environment. If I have a webcam, you guys can see me. Now, I'm going to stay hidden today. I don't really feel like being seen right now. Because the only thing that matters is for us to look at charts. You don't need to see my my pretty face. Anyways, the irony of the whole thing is we've delayed this webinar for like about 2 months, right? Because holidays, and then we had technical issues and so on and so forth. And of course, 2 months ago, the idea of low volatility trading was very, very timely. Now, it's a completely useless concept because we've gone from a low volatility market to a high volatility market. And I think if nothing else, that actually is a very interesting point. It basically shows us that market environments never, ever, ever stay the same. That no matter how long you think something is in play, there will come a time, there will come a day where the environment will change, where every single breakout is going to work, and where every single fake out is not. And conversely, it will then go back the other way, where chasing momentum is going to be very, very negative, and selling highs and buying lows is going to be very, very rewarding. So I guess my initial point to you is the title of the webinar is a testament to the fact that markets change continuously. So today we're going to basically talk a little bit about trading and talk about both volatile and non-volatile markets and kind of how we can operate in both environments with a degree of, if not success, but at least higher probability than just simply trading blind. That's the critical thing. Now, feel free, everybody, to post questions as I'm talking, because it's going to be very much a two-way conversation. I don't have any slide deck or any charts prepared, so I'm basically going to go through the ideas that we discuss in BK Forex all the time, that we discuss in our signal service, that I myself constantly trade on my own account, to give you an idea of what I think works in the market in terms of volatility and what doesn't. And we can have a free-for-all. So if you have any other questions, I'll be happy to entertain them. Now, Rob actually opens this up with a really great point. He says that low volatility still applies in some markets like the loonie. And I think that's actually a great starting point for us to discuss low volatility. Thank you for giving me the right topic subject. So loonie is a poster child for low volatility trading. This is a 15-minute chart, right, which kind of looks like there's actually some volatility. But look at this thing. Let's just move it really wide, and then we'll zero in. So this is daily, and you can see daily. I mean, this is 100 frigging points, 100 points, and we've been effectively in a 100-point range. I mean, this looks like a lot, but it's only because it's all on a relative basis. We've been in a 100-point range from basically, well, even from over here. Let's just say from over here. Almost 2 months, 100 points for literally 40 days worth of trading, which is kind of insane if you think about that, right? I mean, I think it's really insane. But mark my words, there will come a day when this environment is going to turn into this environment or this environment. So you need to be prepared. But in the meantime, if you were to examine the loonie and kind of look at this low volatility environment, you have to ask yourself critical questions of, when you're in a low volatility environment, support and resistance are almost everything. They really mean everything as far as trading goes. So when you're looking at loonie, the resistance on loonie is 99.50, and the support is 98.50. And you see, it gets tested, comes back up, gets tested, comes back up, right? And if you're trading a low volatility pair, then the best strategy to use is simply buy bottoms, sell tops. So you're buying 98.50, you're selling Sorry about that. And you're selling 99.50. And if you have, let's say you're trading this, it's a 100-point range, and you trade it with a 50-point stop, right? If you were to do this starting here, that, now you've established the range, right? But the range has really kind of been establishing itself on and off for the last 3 or 4 months. If you were to basically say, okay, this pierced it back up, come back up, come back up, now you're kind of looking at the range, and you see this kind of found the bottom beforehand. If you were to start this, sell 98.50 with the 50-point range, buying it, you basically have a 2-to-1 risk-reward ratio in terms of selling it. That's a very standard approach to how you want to trade it. But the problem with this is that it takes a while, A, to establish a range, and B, by the time the range is established, you really don't know if how long it's going to last. So you don't know how long this kind of a buy high, sell low, mechanics work. So what I like to do is kind of look around at the extremes. At the extremes of the range are the interesting points, because the way you sort of really want to trade this is the bottom gets tested here, and then if it pulls away, and I think if I was trading a 100-point range, for me 25 points would be enough to convince me that the range bottom has been tested. So in this particular case, 98.50 got tested, and then if it bounced back up to 98.75, I would be a buyer with a stop at around 98.25. I would give myself 50-point stop to see if I can make a run all the way up top. And as you notice, even within a range-based environment, I'm always buying on a break my way. I always want to buy on momentum in my direction. This way, you are ensured at least that just from your entry, not from your exits, but certainly from your entry, that you're going with the direction of where the market is going at that moment. And that's very, very important, because you don't want to be guessing the direction of the market. You really want to have the market tell you the direction of the move. So for that reason, it's very, very important for you to, I would say, even if you have a range-based strategy, to let it come back up off the range. Similarly over here, we tested 99.50, right? I would not be selling this until we broke 99.25 to the downside. Here, you break 99.25. It was a very easy break. It came down. And these are daily candles. Obviously, if you were to look at this on, let's just go to 4-hour candles. Let's go 40 days. And you can see how on a 4-hour candle, this is a kind of a perfect type of a environment to trade this on. Now here's the other thing. When you're trading momentum, this is very important. When you're trading momentum, you're almost always going to get reverse slippage, right? You're going to enter into the price, and the price is going to recoil against you. So the drawback of trading momentum is you cannot trade with tight stops. You cannot trade with something like, I'm going to come in for, right at the break, and I'm going to give myself 5-10 points, and then if it goes, it goes. Because what's going to happen is 1 out of 10 times is going to go for that 5 points is going to work. But the rest of the time, it's not going to work. The rest of the time, what's going to happen is it's going to hit that momentum, it's going to retrace back, and then eventually it's going to establish the trend towards you. The big problem is that you never know when it's going to establish the trend eventually. Sometimes it can just go right through the point and take you out. Like here, for example, let's say here you were buying the bottom, right? And you bought 98.75. Here you had a retrace back, right? But if you came in over here, bought 98.75, you had no retrace back. So the drawback of you trying to get cute and trying to save pippage by not overbuying is that you miss the best trade. Generally, the best trade is the one where you come in and it runs away from you. The problem is catching the best trade is very, very hard, which is why when you buy momentum, you want to come in on the price, but give yourself plenty of room to stop yourself, plenty of room to clear the stops, so that in case you have a retrace, you don't get stopped out unnecessarily. And that's how you would trade a low volatility trade like dollar CAD. Now dollar CAD is kind of interesting to me also, because if you were trading this, like right now, if I was trading this, remember that 98.50 has been a very, very strong level of support for the pair. Actually, should be 98.50, right? And once it gets broken, like once it broke to 98.25, I actually would have said, okay, this is a meaningful enough break that I want to short this trade at 98.25. So I would have been short 98.25 to see if I could get a pull-away move to the downside. Now again, as you can see, lots of retrace. So you want to give yourself at least 50 points of stoppage, so that you don't get stopped unnecessarily. So if I'm short at 98.25, I would be stopped here. Let me just make this much thicker. I would be stopped here at 98.75, and as you can see, I'd still be in the trade. This is a 4-hour chart. I'm basically in a trade for 2 days straight and just kind of hovering around. But if it does go, I'm in a good position because this is former support that now becomes resistance. I'm trading against that. The idea being that risk is relatively positive, and it's a pretty decent trade if we can get some push to the downside. That's kind of how it plays out, and you may be able to get something going. So that's a poster child for low volatility, right? And that's how it trades out. Now, the most interesting trade to me right now in the currency market is not the euro, not the yen, certainly not the Aussie, and certainly not the pound. The most interesting trade this whole week has been this little pair. I'm just curious how many of you guys have been trading this pair. Anybody trade Euro Swiss? Yeah, okay, everybody. Dr. Rob says he's in it right now. So those of you who follow me, pound Swiss, same thing as Euro Swiss, pretty much the same story. Those of you who I want to ask actually, Mike Subliski is asking me, do I use stochastic or any other indicators confirmation when entering or exiting a range-based trade? No. Another great question, I think. This is and again, my personal view. What do you see on this chart? This is what I call a naked chart, right? All my charts, I use only one indicator ever. Those of you who know who trade with me, and that's RSI. And I use that strictly for momentum in a very, very specific manner in the euro dollar. Those of you who are part of our BK Forex signal service know how well that works. That's been the absolute workhorse setup of last year and this year. That's been just the pip train for us, because that is a very, very not a high probability, but a very decent edge setup with really, really nice pippage. So I use RSIs. But that is the only thing I use because RSI is a good momentum indicator. Generally, I trade completely and totally naked. I basically only care about one thing: the horizontal levels on the price levels and the highs and lows, both on the weeklies and on the dailies, because those are the only levels that matter. Everything else, as far as indicators goes, is a derivative of the original price. So it's like watching reality distorted. It's like watching a movie of rollerblading or motorcycle riding or hang gliding instead of actually motorbiking or hang gliding or rollerblading. It's kind of nice, but it's nowhere near close to reality, which is where you need to be in order to trade, in my opinion. So I don't use indicators at all because, I find them to be great at telling you what already happened. And what I'm trying to figure out is what's going to happen. So that's my own personal view, but and there are plenty of people that disagree with me, but I don't really trade them. And the one thing I really don't use is Fibonacci retracements. And you can mock me all you want, but I'll mock you backwards. I think fibs are the ultimate curve-fitting tool ever, because for every fib that works, I'll name you 10 that don't. And my point is, it's if I flipped a coin, the price is going to stop at that level, and if I didn't flip a coin, it's going to stop at that level. I really don't care. Currencies naturally retrace half of their move or a third of their move. I don't really need Fibonacci to tell me where the third or half of the move is. I can pretty much eyeball it. Somebody's asking me, do institutions trade like myself with no indicators on the chart? Yeah. I mean, most hedge funds are interested in levels. They're interested in levels. They're not interested in indicators. I mean, there are lots of technically oriented CTAs. Don't get me wrong, but I think most bank prop shops and large amount of large hedge funds that are macro-based hedge funds are trading levels. They're not trading. Honestly, the really big players in the currency market are the central banks, and central banks certainly don't give a damn about indicators. They trade levels continuously. So maybe what I can, the only thing I can help you with is just the idea to start thinking in terms of levels instead of indicators, because levels are really, really important. And nothing is a better example of levels than the Euro-Swiss pair. So those of you who follow me on Twitter have seen me wake up over the last 2 days to basically saying, those of you who, I'm about to show you levels, Boyke. Heard me on Twitter say it's time to put Euro-Swiss on our charts. This was like first thing Monday morning, basically right around here. I said on Twitter, we've got to put Euro-Swiss back on our charts, because this is what I saw that completely and totally changed my mind as to this being dead money to now being live money. And what I saw was this, and this is what I mean about levels. This is a 3-year chart, daily chart, right? And what you see here is this is all of 2012, where we're basically comatose, right? And the highs in all of 2012, the biggest high was like 2183. It wasn't even 2200, right? So the whole year we never broke 2200. All of a sudden we wake up to Monday morning and we're at 2200. We're above 2200. This is a major signal. Whenever you have yearly highs, monthly highs, weekly highs, it goes in that order: yearly, monthly, weekly, highs, lows. Those are significant levels. That's what bank traders and hedge funds and large institutional money look at, because that's what rings the bell on all those desks and says, hey, something is going on. Price is doing something unusual. There must be some meaningful signal behind it, And so, as you can see, not only did we take out 22, we took out 2250 yesterday, and we took out 2300. And it was such a power move that it just took your breath away. And I said today that, hey, this is not over. There is a tremendous amount of shorts underneath this thing, and they're going to try to roll them. And as a matter of fact, when they took out 2350, those of you who followed me on Twitter said, I said 24 is in view. And those of you who were trading with me live today saw that I actually took the 24 trade, because I knew that they were going to squeeze it even past 24, which is very, very likely what they do before they finally relent and let profit taking come in. What you see here is the exact opposite of low volatility. What you see here is high volatility, massively fueled short covering story. Now, the fundamental story behind this basically is that the euro fracture trade is unwinding. What's happening is that everybody woke up to the idea that Eurozone is not going to break up, that the Italians are able to finance themselves, that the Spanish are able to finance themselves, that there is no financial crisis for the time being. And if there's no financial crisis, there's no reason to be short Euro-Swiss. So if there's no reason to be short Euro-Swiss, let's see if we can get long. Now we get long, everybody gets squeezed out. And as everybody gets squeezed out, it creates this incredible snowball effect until sort of the last of the stubborn shorts get squeezed out. And, everybody started calling me today. Dow Jones was asking me, do I think this is the last of it? No, I don't think it's the last of it, because what you see here is this is the key level, 125. That's a big level. Now, are they going to want to try to gun for this? Yes. Will they fail? They will only fail if we go back to the idea of periphery stress. In other words, if the fixed income markets in Europe begin to come back, if we start to fear that there is no European recovery, and this is really basically a bet on European recovery, yeah, this is going to fail out. But if we get just an inkling of better news over the next couple of weeks, you bet your butt they're going to want to try to squeeze this thing up to 2,500, because that's a big, big level. There's a lot of people that are short at this level. There's probably a lot of optionality at this level, and they're going to want to take this out. So this is a very, very powerful signal, powerful move, and you want to respect it. The one thing that you do not want to do, and this is the number one sin of every novice trader, is it's okay if you don't want to participate because it's too wild, it's too volatile, it's too crazy. What's incredibly stupid is to try to stand against this. Is to say, oh, it broke the yearly highs, I'm going to get short at 2250, or I'm going to get short at 2300, I'm going to get short at 2400. It's ridiculous. It shouldn't be this high. Look how high, look how fast, how far it come up. It's definitely going to be, it's definitely going to correct. That is exactly why it doesn't correct, because you and everybody else is human fodder for the longs. So whenever you have volatility breakouts, The most important thing is to actually either stand away or join the trade, but never to fade it. There'll be plenty of time when this thing will show you exhaustion. And when it shows you exhaustion, that's when you may want to fade it. I mean, this is the exact same story that you see in dollar yen. How many people tried to fade dollar yen, right? Here's the critical thing with dollar yen. Dollar yen broke 84. This was a big yearly high. It took out the 84, 85 level. At this point, everybody was trying to pick a top. And at this point, they all got squeezed to no end. And today is the first day where we have a serious reversal. Because as I said to you, the market is going to show you when it's going to get serious, right? Now, it doesn't always show you exactly. It tried to show you here. Everybody tried to short at 87 here and got squeezed because there was one last burst to the upside. That happens. But that was a reasonable trade. This was a reasonable short with an 88 stop, and you got stopped out. Fine. This is setting up to be a pretty decent short against the all-time highs around here. Now, you get short here with a 90 stop. You have a reasonably intelligent short, because what's happened now is that the market has turned, and you may have more profit taking, more distribution back down to 88, perhaps even down to 87 on the yens, as a lot of people who built up the longs, or people who have late longs are bailing out of the position on the downside. But you certainly shouldn't have been short here, or shouldn't have been short here, or shouldn't have been short here, because you really don't know when the top happens. One of the reasons why this looks like a pretty decent turn candle, by the way, is because it's engulfing. What you see here is we did not take out the day's highs, and we blasted through the day's lows, right? I mean, we're blasted through 2 days' lows, right? 1 day and 2 days' lows. That's a very powerful down move. So in order for us to reverse, we need a massively powerful reversal. And the probability being is that the reversal is going to be unlikely with that kind of magnitude at this point. So now you have a reasonable chance, if we end up around these levels, to get short, and 90 is where you want. Now, yeah, Rob is saying 90 is where Abi will be happy. You're right. And I think ultimately it does go to 90. But what Abi doesn't want to do is push it to 90 within 2 days. He wanted to push it within 6 months. So one of the reasons why he let his economics minister, Akari, go out on the wires and say, hey, we're happy with the yen where it is, was precisely because he wanted to kind of put a damper on this speculative move out of the yen. He didn't want to have total capital outflow just yet. They want to, remember, politicians always want a nice smooth ride, and markets never give it to them. So then they have to come back and overlay some sort of, rhetorical control over the situation. So that's exactly what happened, and that's why dollar yen right now may be finally a turn trade. Certainly a reasonable turn trade at this price structure, if that's how we end up today, against a 90 stop. Now, by turn, I don't mean that this is the top. I mean it's just a correction. So I think the reasonable support level now is going to be 8,700, because that's where we broke before and held. And if you're short from the close here towards 8,700, that might be an interesting trade to the downside, right? So even, here's the other, I guess my point I'm trying to make to you is that even when I'm going to go against the trend, I only want to go when the very, very near-term trend is actually in my favor. So the very near-term trend right now is negative, and that's when I want to get negative. I don't want to get negative when everybody else is positive. And I don't want to get positive when everybody else is negative, right? I want the market to give me some signal that my thought process is correct. So let's take a few more questions that you guys may have. Chuck is saying that 84 may be good support. It may be. 84 is very, very far away, right? So, and you may be right. This could be a massive correction. Nothing surprises me in the markets anymore. But I think the first order of business as far as a correction is going to be to test this. So if I was targeting my shorts, if I was going to get short at the end of the day today, I'd want to target 87 as my short, as a trade to the downside. Now my friend Steve Collins is saying that real money is selling dollar yen. Yeah, which it could be. A lot of people now. The thing is, the thing that's beautiful about the markets is it's like the Lord of the Rings behavior, right? The moment they smell weakness, instead of offering an extending hand, they try to stomp the guy while he's on the floor and make sure not only that he does not get up, but he never gets up. So my point is, don't fight the market. Join the bastards when they move. So that's yen. Now let's talk about the euro, because we really haven't addressed the euro. The euro has been in many ways a side story, kind of like a supporting actor in a lot of this style, in a lot of this movement, because the really big moves were in Europe. I'm sorry, I'm trying to delete the stuff. The really big moves that, a huge part of this move was due to this move, right? I mean, now this is a friggin' move, right? This, by the way, also, look at this. Look at this. This is really, really interesting. So here we are. What's the low over here? 61, right? The low here was 64. We literally came within a couple of pips of a two-day low. We break the low here at 61. That's very negative construct. That is a bearish construct. That is really looks like it's going to be a top in the making. Now, can it reverse, go back up to 120? It can do anything. That's what markets are for. That's why you need stops. But is this a relatively high probability edge trade that we get a little bit further, more to the downside? Yes. So to me, we end up anywhere here. I want to be a seller at 1760. I want to sell the lows to see if they can push this thing maybe 1600, and obviously the natural level of support is 1500 in the euro yen, right? So a couple of commentaries here. Rob is saying that Japan has a dual problem. One, they need a weak yen to export, but they need strong yen to buy oil. And so they need that 90 level, which is a fair balance. It basically is cheap enough for them to export, but not so expensive that they can't, that they have to, pay up for oil too much. It's a good point, and it's an interesting one. And I bet the Japanese only wish that they could frack the hell out of their island, so they never have to think about oil again. By the way, I don't know how many of you following the whole Japan, China, tiny little island stock. I mean, those islands look like they were straight out of a 007 film, right? I mean, tiny little islands. They look like basically a puddle of sand in the midst of all this ocean. And you got to ask yourself, why are these guys literally on the edge of war because of those, on those islands? Because it's certainly not anything interesting. And the reason why is because underneath those islands, people believe there's literally 1 billion barrels of oil. I mean, there is so much oil underneath there that they think that it could set up Japan independent for the rest of its natural life, or however long it goes. And that is why they're willing to basically go to toe, because this is the single most important economic find for people in the region. So I have to watch that very carefully, because that's actually, to me, one of the unexpected risks. And nobody really thinks seriously that Japan and China are going to get into a conflict, but trust me, this is big enough that they will want to go to conflict. And China, at this point, has absolutely no filter whatsoever. I mean, I don't know what, they are basically acting like they don't care. They will go to, they get a big enough ship, they'll just put it right in there and challenge the Japanese to take it away from them. Right. And of course, we are a ally of Japan, so of course we'll get dragged into this one way or the other. So that's an interesting geopolitical story that could develop this year. Anyways, back to the euro. I kind of just wanted to finish up with the euro here. The euro is if you look at this on a longer, this again, we go back to the idea of levels. So the levels here, first we had the 3280 level, which we broke out, and now we open up a little bit more space over here. But the real level here that everybody is combating is this 3435. You see this distribution level? We need to chew through this level. Take it up to 35. That creates a very, very powerful move in the euro. But we stall out over here, right below this, then we could come back all the way down to 130. So the euro, on a longer-term basis, looks bullish for this following reasons. You have a series of higher lows. Remember, the uptrend is not told by the highs, the uptrend is told by the lows. As long as the lows continuously end up at a higher point on a chart, that tells you there is support of buyers. Smart buyers are willing to buy down and hold the value of the currency and in hope of it rallying further. So to me, the euro still remains in a longer-term uptrend, but stalling out over here. We need to break out. We need to take out 3410 to the upside and really kind of take out 3450 in order for us to have a very, a legitimate challenge of 3435 level, which is the next big level for the euro. We fail over here, then we could unwind all the way down to 130, which is a natural level of support. And that's how I would be trading the euro right now. To me, it's kind of in an indecision point, trying to figure out which way to go. Obviously, today is a pretty negative day, and if we have a second day where we don't break the highs, the pressure is going to build for further distribution and a move back down to the 130s in the euro, whether it be profit-taking or fears over U.S. going bankrupt or fears that the Eurozone is not going to recover as fast as everybody thinks it will. So that's pretty much how everything sets up, guys. That's kind of how I look at volatility. I look at volatility in terms of levels and what the charts are telling me instead of trying to figure out what I should be telling it. And then out of what the charts, I try to develop a couple of scenarios that make the most logical sense with logical stops and logical entries to try to take advantage of the thematic ideas that are coming out. So yeah, Rob is finally saying that the Japanese are annoyed at the fact that we kind of devalued the dollar continuously, which is very true. I'm sorry for yawning, guys. I've been up like for already 10 hours, so it's way past my my nap time. Anyways, this is the story as it shapes up. The pound is the only one we haven't really touched. The pound looks horrible to me. The pound had this. You can't really see this. I kind of want to. You know what? This is a much better. Let me go on the weeklies. You'll really see this on the weeklies. Here's the reason why I'm bearish pound right now. Now you can't even. The thing is, this is an ACK candle that goes all the way up to 63.80 and then reverses. That's a very, very ugly reversal candle. The reason why you can't see it is because it's right on the 2003 mark. It basically kind of spiked out to the highs, and this high has been the operant negative force on the pound that's kind of continues to drive it lower. Now we have been holding above 160, so what you're getting is kind of a triangular pattern where you get higher lows, lower highs, and the resolution one way or the other is kind of determines direction as we go forward. So the pound to me is a little bit indeterminate right now, but still the downward bias is the key thing. We break below the 160 level, then we have a possibility of going all the way down to 158.50 and perhaps even lower. So the pound to me, negative until proven otherwise, is the trade here in terms of the charts. Let me take some more questions, guys. I'm happy to discuss anything else that's going on. Markets seem to be just going nowhere fast, so it's kind of very, very dull markets for the time being. Again, the biggest story that we're seeing is the Euro-Swiss story, but even that is finally starting to come to its higher ends. Rob thinks that cable is sideways long term. It may be sideways. Cable to me is a function of whether the UK economy can muster any kind of growth this year. And right now, I think the jury is still out on that. Round numbers are always watched at all levels because round numbers is what most participants are not watching the screens every 10 seconds like you and I are. And even central banks, even if they are watching, they like to, buy and sell this. I'm sorry, guys, I'm going to have to pretty much end the, I have a lot of construction going on in the office, so I'm going to end the webinar and spare you the noise very soon. But I will say that, yes, round numbers are important levels to watch in all of these things, because those are the key levels that tell you if you have possibility of continuation or possibility of rejection, which is the major question you always ask yourself when you're trading. All right? All right. Anyways, just 2 more questions, and then I got to go. Any other thoughts that you guys have? I'm happy to discuss anything else. I don't know what your second question is, Boyke. All right. 50s and 25s, yeah. I mean, they're minor value. I still think that the major, if you're looking at major levels in major crosses, it's the OOs that matter. The 50s to 25s, this is all within the days highs, days lows. They do matter, but on a longer term basis, I think it's the round numbers that matter. Anyways, I'm wishing you guys the best of luck, the best of trading. See you guys next month. I do think Euro Pound is still going up, although Euro Pound really kind of ran into resistance. We kind of failed out at this 24 level again, and that to me is a negative sign. This is a weekly chart, and if we can't get back up above 83 on the weekly, I don't want to be long this thing. So that's kind of how I'm looking at it. All right. Thanks, guys, very much, and I will see you. I'll see you next month. Take care. Bye bye.